Welcome to another episode of Ask an Advisor. Today I'm joined by Jason Calleja, Senior Financial Advisor at FMD, and we're going to look at what's been a pretty contentious, likely new tax on superannuation, Jace, the Division 296 tax, which we understand, whilst it might not go to Parliament this week, it might be next week or the week after once the parliamentarians get themselves sorted. So, Jason, let's start with the basics. What is Division 296?
Thanks, Lee. So Division 296 is a new 15% tax on people with super balances above $3 million. And that includes accumulation accounts, pension accounts, and defined benefit accounts. It's going to be taxing not only realised gains, but also unrealised gains. And the way that it's going to work is similar to a Division 293 statement. So if you're a high income earner, you'd be familiar with this, is you get issued a notice and you will be asked to pay a certain level of tax. And you either need to pay that personally from your personal cash reserves or release some funds from your superannuation to fund that there.
Okay, and so whilst not currently legislated, it is likely to be backdated to the 1st of July this year?
Correct, yeah. It's expected to be retrospectively applied to the 1st of July.
And contentiously, I think one of the big contentions is that it will also not only apply to realised earnings, but unrealised capital gains. Is that correct?
Yes, that's the big one, and been getting a lot of media attention is around those unrealised capital gains. So it's quite unique compared to the current taxation.
Yes.
But it is expected that's the way that it is going to be legislated.
Great. So let's just clear up a couple of things. First of all, how does the $3 million threshold apply?
It's a good question. It's one of the common, misconceptions at the moment is it's on an individual basis. So if we look at a self-managed super fund, there could be a total super balance of $5 million, and the members have a balance within them. There could be $2.5 million each. They won't be impacted by this tax initially.
Yep.
However, if one of the members does have a $5 million balance and the other one has a $1 million balance, one of those members will be impacted by this new tax.
Yeah, great. Okay, so let's unpick earnings then, because the tax is on earnings, yeah? So what does earnings mean in this circumstance?
That's a good question. Earnings can mean lots of different things, but in this particular case, earnings is looking at income. So that could be dividends, rental income, and growth. As we touched on earlier, both realised growth and unrealised growth.
Okay, and that earnings calculation is net of any withdrawals or contributions to superannuation.
Yeah, correct.
It excludes those.
So if you're making any super contributions, they'll back that out so it doesn't inflate the balance. But also if you're making withdrawals, that could be pension payments, lump sum withdrawals, they'll add that back in so that you're not manipulating your balance just before.
Yeah, great. All right, well, why don't we dive in? It's a bit complex, but let's give us an example, Jason.
Yeah, so a simple example is, look, say you start the financial year with a super balance of $3.2 million and then finish the financial year with a balance of $3.5 million. And we assume there's no contributions or withdrawals to keep it really simple. That equates to growth of $300,000, but it's really important to note that the 15% additional tax doesn't apply to that full $300,000. There's a formula, which is based on the Div 296 formula. And for this particular example, it results in around 14% of the 300,000 being taxable, or 43 grand of that 300,000. So that's taxed at the 15%, which equates to additional tax of 6,500. And if we bring that back to the total growth to 300,000, it's around 2% of that. But we do acknowledge for clients with larger balances, so let's say 5 million plus, there will be a greater portion that is taxable.
Yep.
So they'll be impacted more heavily.
But it's a good point that this doesn't make super a bad strategy for people with more than $3 million, isn't it?
And look, I think the government knows that. That's why they're pushing ahead with this. It's still quite a tax-effective tool. And look, we'll explore options with our clients around whether that's taking money out of super and investing that outside in their personal names, a family trust, a company. Some other options could be an early inheritance or loan to the kids.
Yep.
There's potentially using charitable trusts if you want to go down that path. And then the other one, which is subject to caps, is redistributing the super balances. So from one client to their partner, assuming that they've got space and are eligible at age-wise.
To see if we can keep either one or both under the $3 million.
Exactly right,
Yeah. And I guess we've been thinking about this a lot with our clients and looking at particular examples, and taking money out of super to avoid the tax sometimes comes with other trade-offs, doesn't it?
Yeah, well, first of all, it's not always more tax effective, even though that's the intent. And it adds more complexity and sometimes not as much flexibility too. So there are considerations that you need to look at before making that call.
Yeah. So, and if you've got questions about that, please speak to your advisor. We're looking at this all the time. One of the other areas that keeps coming up, Jace, is defined benefit pensions and what the implications of this tax might be on them. Have you got much insight into that?
Yeah, look, that is probably the biggest gap in this legislation at the moment, is how they'll be treated. From what we can understand at the moment, they'll use the family law method. Without going into too much detail, it's looking at life expectancy of the member. Is there a reversionary nomination to a spouse? So that will come up with a multiple and they'll be applied a lump sum value. And the challenging thing for those clients with defined benefits is it's a bit of an unknown at the moment what that calculation is going to be. So until that's all legislated, we need to wait until that comes through.
Yeah, so we're waiting to see some more information on that. If we were to wrap up though, what would your advice be to clients and others concerned about the $3 million super tax?
Yeah, so as much as it's getting a lot of media attention, the first thing is, look, don't panic. We've got time to work through this. As I touched on earlier, look, superannuation is still a great tax-effective vehicle and probably will continue to be for these clients impacted by this. So before taking money out and not be able to get money back in, please make sure that you do understand all the implications of the new tax. And that, look, speak to your advisor, as Lee mentioned. We're here to help, talk through any different scenarios for you, and ultimately make sure that you're making the right decision going forward.
Great. Well, Jason, thanks very much for joining me to talk through this pretty complex and contentious topic. We'll share more about this topic as the legislation becomes clearer. And in the meantime, if you've got any questions, please speak to your advisor. Thanks for joining me for another episode of Ask an Advisor, and we'll see you again soon. Thanks.